Welcome to Market Monday from the investment team in the trust department at the First National Bank. There are quite a few data points coming over the next couple of weeks, and some of these are things that would be consequential under normal market conditions, but conditions are even more exaggerated right now because of the language and the messaging around the last Federal Reserve meeting during the press conference. It was explicitly stated that the Fed is going to be looking at the data points and basing their actions reactively on them. In other words, they're not in a hurry to cut rates unless the conditions warrant it, and they're not going to hike rates unless the conditions warrant it, and rather they're most likely taking a wait-and-see approach. It seems to us that the media community missed this message entirely, and the markets actually have reacted in an upward and generally positive fashion as well, seemingly having taken that commentary to be the green light for rate cuts in September. We don't think that's actually on deck unless we continue to see, inflation trending down and potential weakness in the economy. However, what we got over the past couple of weeks, while we did get a couple of softer than expected reports, we got a couple of reports that came in showing more strength than expected. So what does that tell us? Well, the message is a bit mixed. So the data points coming now that indicate inflation, which are major points this week, include the producer price index and the consumer price index tomorrow and the day after, respectively. Now, when we look at what PPI expectations are, that's supposed to come in flat in the year-over-year, in the month-over-month number anyway, and in the year-over-year number, it looks like there's an expected decline of 0.3%. Now, when you look at the ex-food and energy, when you take out the prices of food and energy because they're volatile, that's also supposed to show a commensurate decline, at least according to the analyst forecast. If this number comes out hotter than expected, that would, in other words, higher than those numbers, that could lead to significant market volatility because the recent day's trading, last week in general, has been strongly to the upside in equities, and that argues that maybe people are going to be caught off sides if these numbers come in hot. So we're paying attention to this event. The same thing with the next day, the consumer price index, which is expected to actually show 0.2% growth when in the prior period it declined by 0.1%. So that's actually potentially the expectation there is showing that a reignition of inflationary pressures, and the year-over-year numbers are basically expected to come in flat. Again, an upside surprise here could lend itself to arguing for more restraint from the Fed coming down the pike and potentially lead to volatility in the market. And we already saw some of that, which we'll be talking about later in this program. We get information on the manufacturing sector and sales, and this is really important. Sales are actually expected to show a jump of 0.4% when in the last reading they were flat. Once you take out auto and gas, you see a pretty pronounced decline that's expected, but we have to wait and see. The reason this is important, though, is consumer spending is 2/3 of GDP. We'll get labor market information, and we'll get industrial production and capacity utilization. We'll get information on the real estate market and sentiment index, the University of Michigan sentiment index, which is important because, again, consumer sentiment is leading to consumer spending, and consumer spending is the main driver of GDP growth. We get the leading economic indicators, which are expected to show a decline of 0.3% versus the prior decline of 0.2%. This number is less consequential than it used to be because it's been reading negative for quite a while, and we've not seen a quote-unquote recession. So, is it really a big market-moving number? Possibly, but possibly not. We'll get the meeting minutes, which go into more detail from the Federal Open Market Committee as to what they're thinking and what they're looking at. And we think that this language might show a little bit less dovishness or willingness to cut rates than the market is expecting. So, we'll take a look and see what happens there. We get information again on the labor market and the real estate market to round out the next 2-week period. All of this is adding up to a rather uncertain environment, and the markets don't like uncertainty. And we're leading into the fall as the kids are going back to school, where September and October historically are the most volatile months in the stock market. And as you can see, we had a major decline, a pullback here from basically up around 5,700 down all the way to 5,100, and now it's rebounded in the S&P 500, basically after the market kind of got this idea that rate cuts are coming from a couple of weaker than expected economic reports. What does all this really mean, though? I mean, you're looking at a pretty strong uptrend that started in October of 2023 and is continuing on throughout the year. This could be a normal pullback, or this could be the start of something more ominous, particularly when we look at the daily ranges between the highs and the lows, which are increasing pretty dramatically, and that tends to be associated with higher volatility. And let's talk about the VIX. You probably heard about this on CNBC or Bloomberg or Fox Business, where this indicator essentially measures protective activity taken in the options market to protect long positions, and it goes really, really high under times of market stress. And it's notable that it got all the way up near 70 recently, like within the past week, and that was, I believe, last Monday, and we came in, the VIX had spiked up to 70, and that's a level that has never been seen except during the 2020 COVID crisis when we were about to enter lockdowns. And that indicates an extreme amount of uncertainty in the market. It also indicates that, when you extrapolate the math behind that formula, markets are expecting daily average moves of somewhere around 4% per day, between the high and the low. That's big in terms of expectations. Now, it only stayed there for a little while on Monday and then came back down. So we'll have to see what happens. Maybe that was just a market-based dislocation of a disproportionate number of puts being bought on the index. Who knows? But in any case, it is a big, big warning sign. It's a red flag. We need to be paying attention. Far from what the media has said about it, we don't think that marks the end of volatility. That marks the beginning of a volatile season, and potentially there are going to be more waves of this. As you can see from the chart, when there's a big spike, there tend to be rapid follow-on waves, and these waves can be excessive when we reach a high this high. So, we don't have a lot of data points to look at, but we can say that we expect bouncing around of volatility to happen and it to continue into the fall. And let's talk about these CPI numbers. We're still, at levels that are above the 2% that the market is looking for, or that the Fed is looking for. Consumer prices last rose by 3%, and they're expected to be showing a little bit of a rise again. It's not deflation, it's just that inflation is slowing down, even if expectations over here are hit. In other words, it comes down to, actually, that looks like flat. So if it's flat, that's not coming down, that's not moving in the direction that the Fed wants it to, and that doesn't argue for a rate cut unless, that's actually coming down pretty dramatically. Now, the same thing on the producer price index, which is expected to come in, with a little bit of, this looks like it's expected to rise. So is that indicative of a rate cut? Probably not. So we have to watch these two particular news releases pretty carefully. In terms of rates, it's interesting what's happened in the yield curve over the past month. In the past month, the 10-year paper has come down 25 basis points and 30-year paper is down 17. That suggests that, yields are coming down because bonds, there's a demand for them, potentially on the signals that have come in recently for weakening in the economy on certain reports will be driving this, and also expectations that inflation is going to come under control over the longer term are starting to take root. And I say starting because these are not very big numbers. In terms of corporate bonds, those rates are down now too, and you can only be above 5% inside of a year. Now we're in the 4% handle all the way out until we get to, say, 12-ish years that we can get 5% or above in corporate paper. But still, we're nowhere on this curve below 4.5% roughly. So those are still great rates by recent standards. And when I say recent, I mean quite a bit. Moving back in, what does this all mean? Well, we are forecasting greater volatility over the near term. But does it really matter? I mean, when we take a look at a 20-year chart of the S&P 500 and you've got these big dips in there, 2022's bear market, you've got the COVID crisis, you've got just various dips that have happened, including the great financial crisis in '08, but the overall move is overwhelmingly to the upside. We make our plans based on this long-term view of the markets, and we think you should be doing that too. If you have questions, if you have concerns, please reach out and call us. We don't think it's the time to make any adjustments, regardless of whatever volatility comes in. So hopefully you found this video useful. Thanks, and have a great day.